Hi everyone. It's been a while since I've produced a video. There have been many people who have reached out asking where I've been, and I owe many of my long-term viewers an explanation. For many months, I felt uninspired to create new content. I wouldn't call it depressed, just not terribly interested in producing new videos. YouTube has been a bit of a disappointment lately. It seems that the only way to raise a lot of interest is to cheerlead for one asset or another, with promises of quick and easy gains. And that's really not what I'm about. I believe that the true and dependable road to riches is a slow one. Work hard, spend less than you make, and invest the surplus in something that will retain or hopefully grow in value. That's all. It's not an exciting message, and I've left several hundred videos on this channel already that will teach anyone who is interested how to do it. Daily videos would just become repetitive after a while. The other thing has to do with YouTube monetization. After turning it on for a couple of years and watching the trends, it seems that YouTube treats creators like trained monkeys. There are formulas that drive content, and I'm not interested in compromising in order to make a few dollars. Sure, it's always nice when someone decides to contribute via my PayPal link. It always feels good to know that my work is appreciated, but the YouTube algorithm is just the pits. I filled my time instead with family activities, home improvement projects, and volunteer work. All of those have provided quite a bit of fulfillment. I'm still going to produce videos from time to time when the spirit moves me, but I'm not going to make myself a servant to the machine. I expect due to the lower frequency of videos, YouTube will gradually stop suggesting my content to new viewers, and so this channel will likely fade into obscurity. Only those who actively look will be able to find this content. So with that said, I felt inspired to make a video today. It's been a while since I've done a valuation video, so I decided to provide my predictions about the upcoming 10 years. Notice I didn't say 10 days or even 10 months. I personally believe short-term predictions are meaningless. Sure, some people will get short-term calls right once in a while, but I think that's more luck than anything else. So let's start by taking a look at the US dollar relative to gold. I spent a lot of time studying how gold and the US dollar relate to one another. No other relationship is as fundamental as comparing the money of kings to the world reserve currency. I found that the data that is most useful is that which follows the year 1980. That was the year when the gold derivatives market really started to take off. And since gold derivatives are still in use and are very popular, it's the data from the last 40 years that are the most meaningful. The US dollar is partially collateralized by gold. I've talked about that many times in the past, and so I won't rehash it now. Currently, the ratio of physical Federal Reserve notes to the market value of U.S. Treasury gold is 4.85. So the dollar is roughly 20% collateralized by gold. The level of collateralization has changed over time. In 1980, we were almost at 1-to-1, meaning the U.S. could have gone back to a fully backed gold reserve system if it chose to do so. In 2000, the US dollar was only a little bit more than 10% collateralized. The level of collateralization is a sign of how much trust there is in the currency. It is a confidence measure. Generally, periods of peak confidence are followed by ruinous results. Periods of peak doubt are followed by appreciation. I expect over the next 10 years that the US dollar is going to decline against gold by about 5.7% per year. And this is another way of saying that the nominal price of gold 10 years from now should be roughly twice what it is today. Of course, if we see a hyperinflationary event, the dollar price of gold could go considerably higher. Predicting a hyperinflation, though, is fraught with difficulty, mainly because hyperinflation is a mass psychology event. One way to guard against the depreciation of the currency is to lend it out. Right now, the 10-year Treasury note yields 3.9%. So gold should outpace treasuries by about 1.8% per year over the coming decade. In addition, though, it's worth mentioning that a person can hold gold without being taxed on its appreciation until the time of sale. The same thing can't be said for owning a bond. I'd like to offer one caveat to this model that you see in front of you. As I've said, it's a longer-term predictive model. Short-term, I expect some weakness in gold, and let me show you why. Here's a slide showing the growth rate in currency in circulation. Over the past 5 decades, its rate of growth has been remarkably consistent, the exceptions being right now and in 2007 to 2009. We know what happened in 2008 and 2009 in response to the slowing in the rate of growth of the base money supply. And I expect something similar to happen as a result of the current slowing in the rate of growth. We've already seen some weakness in the price of gold, and also in the stock market for that matter. I think we'll see further weakness until the Federal Reserve decides that it needs to backtrack. It took a significant stock market bear before the Federal Reserve goosed the money supply starting in 2009. Maybe we should expect the same now. I think it's a reasonable bet. But also, remember what happened to the price of gold after the Fed started pumping the money supply in 2009. The gold price rocketed up until it hit a speculative peak in 2011. And these things are tough to time. Now let's turn our attention to silver. Most people in this community are aware that there are advantageous times to speculate in silver and times when it's better to hold gold. History has proven that out. I'm showing here, post-1980, the 10-year annualized return of silver relative to gold versus the gold-to-silver ratio. Most of the past results when the gold-to-silver ratio was below 65 had gold outperforming silver. Of course, that's not where we are today. Today, we have a gold-to-silver ratio of 88. It's pretty close to the highest ratio for which we have 10-year performance statistics. A model regressed to the data suggests that silver will outperform gold by about 3.2% per year over the coming decade. So holding silver right now might enable a person to buy 35 to 40% more gold a decade from now. Now that's not to say that the near-term results can't be much better than that. Silver is a viciously volatile metal. I used to be a big silver advocate in the 2000s and managed to convert most of my silver to gold in early 2011 at a gold-to-silver ratio in the low 30s. I'll chalk that conversion up to good fortune more than anything else. I was basing my decisions on psychological factors at the time more than math. There was no other way that I know of to successfully time silver. Let's now look at the broad U.S. stock market as represented by the S&P 500. I have an adjustment factor that I use for U.S. businesses because they have retained earnings and deployed them for productive purposes. It's not a large adjustment over time, but it does lead to a much cleaner and more meaningful statistical regression of past data. Right now, my models are suggesting that stocks will do a little bit better than gold over the coming decade. The level of price appreciation might be about 1.4% per year over the coming decade. And if we add a 1.6% dividend to the relative price appreciation, stocks might outperform gold by about 3% per year. Does this mean that I'm suggesting a person be 100% in stocks? Absolutely not. I don't think the price levels in the stock market today are really compelling. Yet. I personally see no good reason to not hold at least some equities, though. My own personal portfolio does not focus on the S&P 500. I focus on income-producing stocks. A good percentage of the S&P 500 is highly speculative stocks, some of which don't even produce any income, and I don't want to hold those. Right now seems to be a good time to hold some equities for income, some gold for insurance, and some silver for speculative price appreciation. At least that's how I see it. Okay, so that about covers what I have to say today. Hopefully I'll find the inspiration to make another video soon. Until then, have a good week, everyone.